Welcome back to Managerial Accounting. We're going to kick off in approximately the early middle portion of Chapter 12, and we're going to get into something called ratio analysis. Now, as a reminder, a ratio is essentially anything that causes us to divide two numbers by each other, and we usually end up with a number that is greater than 1 or less than 1. Okay? Some general information about ratios. They're not terribly meaningful to us if we just look at them alone. If I tell you, for instance, that a company their debt ratio is 50%, is that high? Is that low? Well, I don't really know until I compare it. I can do what we call cross-sectional comparisons, and that means I will compare that company's ratios to another company or to the industry, which we talked about when we were talking about vertical and horizontal analysis. Or I could compare the company to itself, but I could compare it over time, which is much more like horizontal analysis. Now, there are 5 categories of ratios, and there's a reason we put them into categories. We do so because each of those ratios tells us something a little bit different. It answers certain questions about the company's financial health. Of the 5 categories that are covered in Chapter 12, you only will be tested on 4 of them. So this video will only cover the first 4 categories. All the categories are liquidity, which deals with short-term cash flow. Liquidity deals with how much cash is available right now or very, very soon to pay for the bills that are due right now or very, very soon. Then we have debt management. And when we're talking about debt management, I'm not talking about paying the utility bill or paying salaries. Debt management has to do with the long-term indebtedness of a company and how well it manages that, how well it is able to pay off future debt payments. The third category deals with profitability. And this is probably a bit obvious, but we're talking about how well a company makes profit. Now remember, profit is different than revenues. Revenues is the top line of the income statement. That tells us how much it can do in sales, but after I subtract all those expenses, I'm left with net income, or what we sometimes call profit. So profitability ratios do look at how well the company not only generates sales, but how well it manages its expenses so that it has a profit at the end. The last category that you will be tested on is what we call asset efficiency or operating efficiency. And with these ratios, we're going to be answering questions about how well the company uses its assets to actually generate profits. Lastly, there are a group of ratios that tell us how well the company is making money for its stockholders. This is something we'll cover more in corporate finance, but I would encourage you to look through those pages in your accounting textbook. All right, let's dive into the liquidity ratios. Remember, liquidity is a measure of how close an asset is to cash. So cash is the most liquid asset on the balance sheet, which is why it is the first line item listed. Our assets are listed in order of their liquidity. Now, there are other similarly liquid assets that are just not cash. And so I'm going to be looking at current assets when I'm looking at these ratios. Sometimes not all the current assets, sometimes just some of them, and I want to compare them to the current liabilities. Remember, those are things that the company owes within the next year. I want to see how much cash or things that are really close to cash does the company have that it can use to pay for all those short-term bills. Now, when I'm talking about liquidity ratios, and you will see that I do this for all of the categories, I'm going to tell you that for all the liquidity ratios, the better circumstance is when you have a higher value. And even before I start comparing a company's liquidity ratios to its historical liquidity ratios, or comparing one company's liquidity ratios to another company's liquidity ratios, I can tell you also this, that a company always wants to have its liquidity ratios be greater than 1. If they are less than 1, what you are essentially saying is that company has fewer current assets at this given moment than it has current liabilities. That means it owes more in the next year than it can reasonably expect to convert into cash. in the next year. Well, now that would be some concerning information, especially if you were one of the individuals or companies that was owed money in the next year. All right, so what are those ratios? First one is something called the current ratio, and that is current assets, total current assets divided by total current liabilities. In your book, if you're following along, you can see Cornerstone 12.4, and we're going to actually look at Aeropostale's income statement or balance sheet to determine what its current ratio was for the 2 years, 2010 and 2009. Now, if I'm looking for current assets and current liabilities, what financial statement am I going to go to? Think about it. Excellent. I'm going to go to the balance sheet. So, let's go to Aeropostale's balance sheet. If I look at 2010, and I'm not going to work all the math in this video, you guys can work the math at home. But if I go here, I notice, hey, total current assets were $530,017,000. If you note, this balance sheet is in thousands, okay? So $530,017,000. I'm going to type that into my calculator, and then I'm going to go to the next slide, and I'm going to look for total current liabilities. And what was that in 2010? Oh, yep, that was $241,840,000. If I divided those two numbers, what would I get? Yes, I would get 2.19. Now let's just look at that for 1 second. 2.19, that's 530 million divided by 241 million. 2.19 is definitely better than 1. So I would say, at least before I can do any other comparison, I can tell you that Aeropostale at least is somewhat healthy on the liquidity front, because they have more than $2 of current assets for every $1 of current liabilities that they owe. Now, if we had done the math for 2009, we would have found that the company's current ratio was 2.25 in 2009. So that begs a question. Was Aeropostale's 2010 current ratio better or worse than it was in 2009? Yes, you were right if you said that Aeropostale actually got a little bit worse from 2009 to 2010 when it came to its current ratio, because if you notice, 2010's ratio is just a little bit lower than 2009's. All right, so we've got the current ratio, and then we've got something called the quick ratio, or sometimes we call it the acid test ratio. Now, if you notice, the numerator is definitely different here. What did we do? Well, we took out some of the current asset accounts. Notice it's only going to be cash, short-term investments, and accounts receivable. What's one of the major asset accounts that is no longer in the numerator? Which one of the current assets isn't there? Exactly, it's inventory. Inventory isn't there. Now, why would we take out inventory? Why can't I count inventory as part of the current assets when I do the quick ratio? Well, one of the major reasons is inventory is the business that the business is in, right? Let's say you're Walmart. Let's say you're not actually terribly good at selling things. You've got a whole lot of inventory sitting on your balance sheet, but if you're not terribly good at selling that inventory, is it really fair to say that in the next year you'll be able to convert that inventory into cash so that you can pay your bills? Maybe not. And because of that, we do have this quick ratio saying, hey, whether a company is good at selling their inventory or not good at it, I know that cash is cash, and short-term investments can be turned into cash pretty quickly, and conceivably accounts receivable, since there is an IOU out there, there's an invoice, conceivably that can be turned into cash pretty quickly. So let's find the quick ratio for Aeropostale. Let's just look at 2010. Now I'm going to take cash, and notice theirs is called cash and cash equivalents. Well, often when I see something like that, I know it's possible there are some short-term, highly liquid investments included in the, quote, cash equivalents. Are there any receivables here? Yeah, I don't see any either. So we're just going to punch into our calculators 346,976,000, and we are going to divide that by total current liabilities, which we know that didn't change, 241,840,000. Punch that into your calculator, and what are we going to get? Yes, we get 1.43. Now, once again, we're still over 1. That's good. I still feel like this company is decently healthy. What was it in 2009? Interestingly, it was 1.30. So, from 2009 to 2010, did Aeropostale's quick ratio get better or worse? It went up from 2009 to 2010, and when we're talking about a liquidity ratio, I'm pretty happy when it goes up. So on a quick ratio front, Aeropostale got a little bit better over the course of those 2 years. Lastly, we have something called the cash ratio. Notice, we're taking out even a little bit more. It used to be we had all the current assets in our numerator, and then we took out inventory. That went away, and anything else that wasn't cash, short-term investment, or receivables. Now, look what we're going to take away. We're going to take receivables out of that numerator. It's just going to be cash, which I know is cash, and short-term investments, which I believe can be turned into cash quite quickly, and that's going to be my cash ratio. So I'm going to take that $346,976, and guess what? Since we didn't have receivables the last time, my numerator didn't actually change. I'm still going to divide by my 241,840, and I'm going to discover that my cash ratio was precisely the same as my quick ratio. Now that's for Aeropostale, and that's because they don't have any accounts receivable. Now a company that has no accounts receivable, what else can I say about them? If a company has no accounts receivable, that's right. What I can say is they must not be doing any of their business on credit. Everyone's paying cash. So that's an interesting point. Lastly, let's look at the operating cash flow ratio. In order to find this ratio, I have to find cash flows from operating activities. Now, where can I find that account? If you said the cash flow statement, then you're right. It's going to be cash flows from operating activities divided by current liabilities. Now, I don't have a copy of Aeropostale's cash flow statement, but we're going to follow how to do this anyway. I know that my denominator needs to be the 241,840,000. What if I told you that in 2010, because that's the number I'm looking for, in 2010, the cash flow from operations was 334,440, and I'm going to divide that by the 241,840. And if I do that math, I should come up with 1.38 for my cash flow, operating cash flow ratio in 2010. And if I did a similar calculation for 2009, I'd come up with 1.15. So that leaves us with the final question on liquidity. Was the operating cash flow ratio for Aeropostale, was it better in 2010 or worse? If you said it was better in 2010, then you are correct. Okay, so next that leaves us with debt management. Now that's talking about the long-term debt management that a company has to deal with. These are the long-term debts, the loans, the mortgages, the bonds that they have to pay. This isn't, like we said, paying the utility bill. There are certain things we really care about when it comes to debt management. First of all, if you remember, debt and equity are the two main ways that a company can finance its assets. That's how it buys its assets. And a little bit of debt is good. It allows the company perhaps to purchase more things, big things, where they need a lot of money all at once to be able to grow. And sometimes equity is an extremely expensive way to finance a company, something that we'll talk about much more when we get to corporate finance. And another good thing about debt is that there is a tax-deductible portion of debt, and that's the interest payments. Also remember that your creditors, those are the people that loan to you or the organizations that loan to you, they don't own you. They are not owners like shareholders are. However, debt is riskier than equity in one very, very important way. And that is that there is a contract that obligates you to repay when you get into debt, which is not the same when you get into equity. So what the ratios tell us when it comes to debt management is what is the mix of debt and equity, and what is the company's ability right now to meet its obligations. Okay, the first ratio we're going to look at is something called the TIE ratio, the times interest earned ratio. Now that might actually sound a bit odd, but what that is operating income, the company's operating income divided by its interest expense. For every dollar in operating income, how many dollars of interest expense is there? Now, obviously, I probably want this ratio to be greater than 1, right? If a company has $100,000 of interest expense, I really, really hope they have more than $100,000 in operating income, because if not, they don't have enough operating income to pay their interest. They don't make enough to pay the interest that they owe. And remember, debt is an obligation. Okay, so let's look at Aeropostale. Actually, we're going to look at Delta. So just don't mind that little typo there. We're going to look at Delta Airlines. The reason we're not looking at Aeropostale, if you didn't already notice, Aeropostale actually owes no interest because it owes nothing in terms of debt. So none of these ratios would have been very interesting when it came to Aeropostale. They would have had zero debt management because they have zero debt. So let's look at Delta Airlines, a company that does have plenty of debt. Now these are a mix of their balance sheets, and if you notice, there's several items of income statement information down here for years 2008 and 2009. What I'm looking for is operating income, right? And interest expense. So operating income, I'm going to go down here and I'm going to discover, let's look at 2009. 2009, the company had, well, actually they had negative operating income. They had an operating loss of 324, I believe this is in millions. They're 324 million. Now, what was their interest expense? Well, I see that right here. It was 1.2 billion. This is not looking too good for Delta now, is it? Because if I took negative 324 into my calculator and then I divided by 1278, wow, I come up with a number far less than 1. And remember, a high value is much better. Yes, I come up with a negative 0.25. This company has negative 25 cents of operating income for every dollar it owes in interest. That's not a good position. Now, how bad was it in 2008? Oh, it was a lot worse. They had negative $11.79 of operating income. They were in the hole, $11.79 for every dollar they owed in interest. Was Delta's TIE ratio better or worse from 2008 to 2009? Well, it's kind of hard to say anything good about these ratios. However, we can say that Delta was not as bad off in 2009 as it was in 2008. Another ratio that we're going to pay attention to in debt management is the long-term debt to equity ratio. Now, this is going to include all long-term debt in the long-term liabilities section of the balance sheet, as well as the current portion of any long-term debt. Now, this would mean any debt, like bonds or a loan, that had a maturity of more than 1 year, but the current portion would be the piece of principal that is due within the coming year. Now, we will include the current portion when we look at this. So, if we were going to look at Delta's information, I'm going to go first to their non-current liabilities, their long-term liabilities, and I see long-term debt for 2009 of $15.665 billion. Is there any current portion to their long-term debt? I'm not seeing any either. Oh, yes, go a little higher. Very nice, 1.533 billion. So I'm going to add those two together. I'm going to put them in my calculator. And that's going to be my numerator. And then I'm going to divide that by Delta's total equity, which I see right here. Total stockholders' equity for 2009 is $245 million. So I'm going to take the total debt, total long-term debt, which was the 15.665 plus the 1.533, and I'm going to divide by the 0.245. And what I come up with is that in 2009, Delta was 70%, 70 times rather, the amount of debt as it was equity. That means for every dollar of equity, there was $70 in debt. That would be telling me that most of the assets that Delta owns was paid for with debt. Now, in 2008, it had approximately 19 times debt to equity. For Delta, did it get better in terms of its long-term debt to equity ratio from 2009 to 2008, or did it get worse? Well, you see there in the yellow that a lower value is better for a ratio like this. I would rather have a little less debt compared to my equity, and it turns out that Delta definitely got worse from 2008 to 2009. Next ratio, debt to equity. This is almost the exact same measurement, except instead of just focusing on the long-term debt, we are going to take all the liabilities and divide them by the total equity. I'm comparing how many dollars of liability does the company have versus dollars of equity. Once again, a lower value is better. If I look for the total liabilities here, I would need to add the total current liabilities plus the total non-current liabilities. I would add those together and determine that it's approximately $34 billion of total liabilities, and I'm going to divide that by total equity here. And I would find, if I put all that into my calculator, that in 2009, for every $1 of equity, Delta had $176 of total liabilities. They had approximately $50 of total liabilities in 2008 versus every dollar of equity. So, did Delta, in terms of the debt to equity ratio, get better or worse from 2008 to 2009? Yep, they got worse. Two more. And then once again, they're very similar. If you noticed, long-term debt to equity ratio was almost the same as the debt to equity ratio, except I take all the liabilities into the numerator for the second one. We're going to do two others that are very similar. We have long-term debt to assets or debt to assets. The only difference is total liabilities in the numerator for debt to assets. In both cases, a lower value is better. So, if I go back, long-term debt, and that is going to be including the current portion, long-term debt, these two numbers divided by total assets right here, $43.5 billion. Well, if I did that math, I would come up with long-term debt to assets was 0.4, and the total debt to assets was 0.99. I want you to do a little conversion in your head. If I say 0.4, what is that in percent? Yes, 0.40 is equal to 40%. 0.99 then is equal to what? Exactly, 99%. Do you know what these two ratios are saying? What they are saying is assets have to equal total debt plus total liabilities plus total equity, correct? 40% of the asset value in the company was purchased with long-term debt. 99% of the total asset value in Delta's company was purchased with liabilities of some sort. This company is 99% financed by debt. That's 2009. Was it better or worse in 2008? If you said that the company was slightly better in 2008, then You are correct, but this is not a flattering picture for this company. We're going to pause here for this video, and the second video will cover the asset efficiency ratios as well as the profitability ratios. See you soon.